Okay, I told you.
Macam mana?
Eh.
Guys, Madam Susanna asked us to discuss about the taxation for leasing business. Should we discuss now?
Yes. Let's
Yes.
get it.
Maybe we can discuss our first discussion with our first topic, isn't it?
I can start.
Let's go! The Income Tax Leasing Regulation 1986 were issued under Section 36 Sub 1 of the Income Tax Act 1967. These regulations clarify the position of the Inland Revenue Board regarding the tax treatment of leasing businesses. They apply to all leasing companies, regardless of the methods used to recognize income. There are two main methods of income recognition in leasing. First, the finance lease, where the risks and rewards of ownerships are transferred to the lessee even though legal ownership remains with the lessor. Second, the operating lease method, where the lessor retains ownership and the lessee only use the asset for a specified period. Understanding these methods is important because they determine how leasing income is assessed for tax purposes.
Did you get it?
Yes.
Okay, that helps. At least now we know the outline and we don't be totally clueless.
Yeah, this makes it clearer. My brain was buffering just now. So next, regulation 1. Hafiz, do you check the effective date, right?
Yes, I have explained, and also hopefully it will be correctly.
I always forget the date like this.
I know. Do not worry. I will clarify and pray for me.
Okay, I will pray for you.
So for effective date under Regulation 1, any lease agreement that affected before 8 April 1986 will not fall under scope of this regulation. So meaning that lease agreement that happened on or after 8 April will be subjected for special rules in ITLR. The example of special rule in ITLR is separate source income and capital allowance. So effective date is really important because it affects how gross income is treated by tax.
Oh, now we get it.
Yeah, that makes sense. Shockingly.
Shocking. Next, for regulation 2, Hafiz, can you continue?
Yes, about separate source of income.
Meaning leasing income is separate from
Exactly.
source. Okay.
For separate source income under Regulation 2, it will be treated separately and distinct business source. For example, the company conducts leasing business and activity like financing, so it must be separate and it will become own category under Section 4A. So the purposes is to prevent cross-subsidy and ensure tax treatment and allowance match.
Now it makes sense.
Yeah, I understand now. Good job, Hafiz. Yeah.
And how?
Oh.
Okay, right now it is regulation 3. Right now you cover gross income.
Okay.
Gross income is total rental, isn't it? I almost panic when I say it.
Let me explain.
Under the Regulation 3, the total rental sums under a lease agreement are deemed to accrue evenly over the entire lease period. This rule applies even if the lease agreement involves unequal installment, such as higher upfront payments. So in practice, the gross income for each basis period must be recognized evenly throughout the lease term, regardless of how the cash is actually received. However, the DGIR has the discretion to allow all rental receivable in a particular basis period to be treated as gross income for that year, if it is considered just and reasonable. Because of this even spread rule, timing differences can occur, especially when the lease structure involves uneven cash flows.
So basically, gross income must be recognized evenly.
Yep. I see.
Shira, can you explain about tax implication?
Sure. I hope.
So for tax implications regulation 3. So number 1 is even accrual requirement. Regulation 3 requires that leasing income be recognized evenly over the lease period for tax purposes. This can restrict how companies recognize income because commercial accounting might use different patterns. For example, front-loaded finance income. As a result, taxable income may not follow the accounting income pattern, forcing companies to adjust their tax computations. I hope you get it. And number 2, differences when lease resembles hire purchase. When a lease is structured in a way that resembles a hire purchase agreement, the commercial recognition of income often differs from how the tax rules treat it. Accounting standards may recognize more income earlier or later in the lease term. However, Regulation 3 still require consistent even accrual, causing differences between accounting profit and taxable profit. And number 3, lastly, is timing differences. Because of these differences in recognition methods, timing differences arise. This means the company might pay more tax in one year and less in another, even though the total tax over the entire lease period will be the same. These timing differences affect tax planning, cash flow, and deferred tax adjustments. I hope I deliver it right and you guys faham.
So, how did I do? You guys understand what I'm trying to explain?
Yes!
And it's good, Mom.
When you explain regulation 4,
Yes, I will explain the deep sale part. My favorite because it confuses everyone.
Under Regulation 4, deemed sale transaction is some leases are not treated as leases for tax purpose. Instead, they are treated as if the lessor sold the asset to the lessee. That means, first, the lessee is treated like the owner, and the second is the lessor is treated like it sold the asset. This happens when certain conditions occur. There are 6 situations under Regulation 4. First, the lessee has an option to purchase the asset during or at the end of his term. If the lessee can buy the asset anytime during or after the lessee, it is called as a deemed sale. Second situation is lessee is given beneficial ownership. Lessee controls the asset as if they are already own the asset. For example, you lease a lorry, but you decide how to paint it, you decide how to repair and maintain it, you decide how to use it, you bear all the risk. This means you have beneficial ownership. It is called as deemed sale. Number 3, asset is a special purpose asset. If the asset is custom made and cannot be used by others without modification, it is considered a sale. For example, a company leases a machine specifically built to produce a unique bottle shape. No one else can use it. If the lessee stops using it, the lessor cannot lease to anyone else. This indicates the lessee is effectively the owner. Number 4, lessee has already claimed capital allowance on the asset before the lease. If the lessee claimed capital allowance before leasing it, clearly they treated it as their own asset. It is a deemed sale. Number 5, lessee is allowed to sell or dispose of the asset and keep the proceeds. If the lessee is allowed to sell the asset, that means the lessee acts like the owner. It is deemed sale. Number 6, lessee acquires the asset during or after the lease term at below market price. If the purchase price is way cheaper than the fair value, it means the arrangement is actually a sale.
I see. Jema, can you explain the tax consequences of deemed sale?
Sure, I can.
There are 4 tax consequences of a deemed sale. First, lessor must recognize the total rental income as sales. All rental income for entire lease is treated as sales revenue. Number 2, lessor may claim the cost of asset as cost of sales. Since it is treated as a sale, the lessor can treat the asset cost like selling inventory. For example, cost of machine is 60,000 ringgit. The lessor claims 60,000 as cost of sales. Number 3, the lessor is not allowed capital allowance because the law now says the lessor didn't own and use the asset. Number 4, lessee can claim the capital allowance because the lessee is treated as if they acquired and used the asset.
Oh, I see.
Oh, that makes sense finally.
Yeah. Yep. Next. common expenses.
Sheila?
For me, again?
Yes.
Alright, let me summon my notes.
Next is common expenses. Number one is leasing as a separate source of income. I believe Hafiz had explained about separate source of income. So I hope this will be more understandable for me to explain. If a leasing company has multiple income sources, leasing must be treated as its own separate business source. Therefore, expenses that are shared across all activities, for example, salaries, utilities, and administration costs, must be apportioned, not fully claimed against leasing income. Next, apportionment formula. The commonly accepted basis is the ratio of leasing income to total income. This ensures expenses are fairly allocated and prevents overclaiming deductions. So the formula is leasing expenses equals to leasing income divided by total income and multiply common expenses. This method is endorsed by authorities and supported by case law. So the case law that is related to this common expenses, to this apportion things, SLSDN VDGIR. The Special Commissioners confirmed that apportioning common expenses using an income ratio is valid and acceptable under Section 33 Sub 1. This case forms the benchmark for how companies should allocate overheads. Number 4, principal amounts not included. There is a case that is related to this issue. The case that is related to this issue is the LSMHD v KHDN. The High Court clarified that principal repayments must not be part of the apportionment calculation because they are capital in nature. The Court of Appeal upheld this, confirming that only income and actual expenses should influence apportionment. Lastly, interest expense from year of assessment 2006. Interest expenses cannot be allocated using general ratios anymore. They must be apportioned based on actual funding used specifically for leasing activities versus other activities. This creates a more accurate and compliant method of claiming interest deductions. So that's all for my explanation for common expenses.
很好。Now, finally, it's my part. I will explain the doubtful debts and the capital allowances. Okay, let's get it.
As we all know, there are two methods of leasing, which is operating lease and also finance lease. The treatment for doubtful debt is depending on the lease method. For operating lease, where the lessee used the asset without owning it at the end of the lease term, the provision for doubtful debts and debt write-offs are treated similarly to other business operations and are deductible if they meet the usual conditions. However, problems will arise if a lease is terminated early if finance lease is used. Finance lease is a lease where the lessee used the asset and owning it at the end of the lease term. The unpaid balance may include a capital portion that was never treated as income. This capital portion is not deductible for tax purposes.
I see. What about capital allowance?
Okay, let me explain.
As for capital allowances, leasing companies are entitled to claim capital allowances on the leased asset. However, such allowances can only be deducted against leasing income. If the fixed assets are used for multiple activities, the capital allowances must be apportioned based on turnover or income ratio. Moreover, capital allowances are restricted to 50,000 ringgit or 100,000 ringgit for the motor vehicles that are not registered for commercial purposes. It depends on the conditions.
That's why leasing company relies on it.
Yeah, I see. Okay, I think we have covered everything. Yes, yep, all parts connect nicely, perfectly,
Bravo everyone, our discussion went smoothly somehow.
Agree. You can explain this clearly as both.
Great job, everyone.